Good day, everyone, and welcome to our presentation on fractional reserve banking, money supply, and bank accounting. Today, we'll explore how banks manage their reserves, how deposits and loans impact the overall money supply, and why a solid grasp of basic accounting principles is essential for understanding bank balance sheets. This is a fascinating topic that reveals the inner workings of the banking system and its vital role in the economy. Let's dive in. Here, we're looking at what fractional reserve banking really means. Essentially, banks don't keep all the money that customers deposit. Instead, they hold only a fraction of these deposits as reserves. The rest is used to make loans or invest, which helps the economy grow. This system is designed to maintain a balance, ensuring banks have enough liquidity to meet withdrawal demands, while also maximizing the money available for lending. So, the key takeaway is that the reserves are always less than the total deposits held by the bank. This delicate balance is what keeps the banking system functioning smoothly. Let's look at the bank balance sheet, starting with the asset side. Here, reserves and loans are recorded as assets. These represent what the bank owns or what is owed to the bank by borrowers. Essentially, they show the bank's resources and how it generates income. On the other side, we have liabilities and equity. Customer deposits are classified as liabilities because the bank owes this money to its customers. Equity, on the other hand, acts as a financial cushion that helps absorb losses and protects the bank's stability. Together, these elements provide a clear picture of the bank's financial position. Here, we're looking at how a bank loan actually creates a deposit. When the bank approves a loan, it doesn't just hand you cash. Instead, it records a new loan asset on its books and simultaneously creates a matching deposit in your account. This means that the money supply increases right away, even before any physical cash changes hands. Essentially, the loan and the deposit are created at the same time, reflecting how banks generate money through lending. This process is crucial to understanding modern banking and how digital transactions work, much like when you log into your online banking on a laptop, as shown here. Here, we're looking at the concept of money supply moving from base money to broad money. First, central bank money, often called reserve money, forms the foundation. This includes physical cash and reserves that banks hold at the central bank, which ensures the banking system remains liquid. Next, we have bank deposits, which make up the majority of money in everyday use. These include checking and savings accounts held at commercial banks. Here we have a clear example of fractional reserve accounting laid out in a table to help us understand the process step by step. Starting with the initial deposit, you can see that the bank receives $1,000 in cash, which also creates a matching $1,000 deposit liability and reserves equal to that amount. Next, the bank holds 20% of that deposit as reserves, which is $200 in cash, and the remaining $800 is available to be loaned out. This is reflected in the assets column as $200 in cash plus $800 in loans, while the deposits remain at $1,000 and reserves drop to $200. Finally, once the loan is issued using the available funds, the deposits increase to $1,800 because the loaned money often gets redeposited, but the reserves stay the same at $200 held in cash. This table illustrates how banks only keep a fraction of deposits as reserves and use the rest to issue loans, effectively expanding the money supply. When we talk about what limits bank lending, there are several key factors to consider. First, reserve ratios establish a baseline for lending capacity. While banks must keep adequate reserves, these ratios alone don't fully restrict how much they can lend. Next, capital requirements play a crucial role. Banks need enough capital to absorb potential losses, which directly limits the safe amount they can lend. Then, risk management comes into play. Lending decisions depend heavily on borrower credit quality and regulatory risk limits, helping banks control the potential for loan losses. Lastly, liquidity needs and actual loan demand also affect how much banks choose to lend at any given time. It's a complex balance between maintaining stability and meeting demand. Here we have a comparison between two different perspectives on how money creation works. On the left, The traditional view suggests that banks can only lend out deposits that already exist, which means the money supply is fixed and loans are limited by these existing customer deposits. This perspective assumes a straightforward, linear relationship between deposits and lending. On the right, however, we see the actual process. In reality, lending itself creates new deposits, which in turn expands the overall money supply. When deposits move between banks through payments, it's the central bank reserves that settle these transfers, not the existing deposits, so the reserves facilitate the process rather than directly limiting how much banks can lend. The key takeaway here is that money creation is more dynamic and complex than the traditional view suggests. Understanding this helps clarify how monetary policy and banking operations really function in the economy. Thank you all for your attention. To recap, fractional reserve banking is the practice where banks hold just a fraction of deposits as reserves and use the rest to issue loans, which in turn creates new deposits. This process is key to how the money supply grows in the economy. Understanding the accounting behind these transactions helps us see the bigger picture of financial flows and banking operations. I appreciate your time and interest in this important topic.